Everyone online argues about this nonstop. You should focus on growth. No, income investing is better. Dividend investing is too slow. Monthly income is all that matters. But what if the real answer is combining both? Right now, I'm investing into 4 ETFs every single trading day: SCHD, FDVV, SPYI, and QQQI. 2 focused on dividend growth, 2 focused on high monthly income. And even though it's only $5 into each per day, this portfolio could become something surprisingly powerful over time. Today I'm going to show you my actual positions, how this strategy works together, and then we'll run a rough projection to see what this portfolio could realistically produce in the future. And the crazy part, I'm building this inside accounts that could potentially grow tax-free. One thing I think investing YouTube gets wrong is acting like growth and income are enemies, because if you structure it correctly, they can actually feed each other. So here's exactly what I'm doing now. I invest $5 per trading day into each ETF. That comes out to about $1,825 per year into each position. Across all 4 ETFs, that's roughly $7,300 invested annually. The growth side of the portfolio is SCHD and FDVV. SCHD focuses on high-quality dividend growth companies with strong cash flow and a history of increasing dividends. FDVV gives me another layer of dividend growth exposure, but with slightly different holdings and section weightings. And on the income side, I have SPYI and QQQI. These are designed to generate higher monthly cash flow using option strategies. So instead of waiting years for meaningful income, the portfolio is already producing cash flow now. And that's where things get interesting. And this is my position into SCHD. Currently, I have $3,352 invested, my total value, my total return, and the annual dividend. And I started investing into SCHD back in August of 2022. It's actually the first $5 bill that I put into investing. FDVV came in August of 2023. That is my total invested, $3172.68. Total value is $3817.65. My total return and my annual dividend. SPY is a monthly payer, $4,086.16 invested. My total value, $4701.65. A 29.08 total return, and an annual dividend, $551.73. I started that position in August of 2023. And QQQI, $4228.87 invested. Total value is $4464.25. The total return is only 12.83. QQQI is a little more volatile, but it's a higher dividend yield, $604.84. And I started that position in August of 2025. The income ETFs can help create immediate cash flow. The dividend growth ETFs focus more on long-term compounding and dividend increases. One side helps me now. The other side helps future me. Instead of choosing one dividend investing style, I'm basically building a bridge between both worlds, because honestly, I think a lot of investors quit too early. Growth investing can feel slow in the beginning. Pure income investing can sometimes sacrifice too much long-term growth, but combining them might solve both problems. And by the way, if you enjoy seeing real portfolios, real projections, and realistic investing strategies without all the fake get rich quick nonsense, hit subscribe. I'm documenting this entire journey in real time, including the wins, mistakes, and how these portfolios evolve over time. And also, too, I am not a financial professional. I am not a licensed financial advisor. Please do your due diligence before you invest. This is for entertainment and educational purposes only, and past performance does not indicate future projections. Easy for me to say. And this is going to be SCHD. We're here into the market beat dividend calculator. We're starting from 0. We're doing a dividend tax rate of 0. We are adding 18.25 every year. And currently, I am going to go light on the share price projections, but SCHD's 5-year dividend yield is closer to 9%, so we're going to use that. And we're going to go out 30 years. So if you started at 18, if you're looking to possibly retire at 50, this will give you an idea of what SCHD can do. We're going to calculate. That would be your possible dividend portfolio after 30 years into SCHD, your balance, your total return, average annual return, your total dividend income, your total dividend payments over 30 years, and your yield on cost. And that is going to be how it projects every year. 1 year, after 5, you're still not making a lot in dividends. Everything is going to be dividend growth. After 10 years, you're starting to get some income there. You're getting it at 4 times a year, as SCHD and FDVV are quarterly payers. After 15 years, still not anything to retire on. At 20 years, you're still a little light for retirement, but it will work well if you're thinking about it with your Social Security. And it's not until you reach that 30 years where you're starting to see serious income with SCHD. It's $81,289.05. And now let's go to FDVV. Now, bear in mind, FDVV has a similar dividend growth rate, but their dividend yield is lower. We're still going to use the same 9% dividend increase. Still that same 18.25 in annual contributions. Still a 0 dividend tax rate. And we're going to go out 30 years for the investment. That would be your ending balance, $403,944.36 after 30 years. Your annual dividend income is a nice almost $65,000 a year. And that would be how it compounds. But the thing is, are you going to need the dividend income now, as opposed to needing it for retirement? Now, obviously, projections are never guarantees. Markets change, dividend yields change, returns change. But I think running realistic scenarios helps make investing feel more tangible. So again, roughly $7,300 invested per year across the portfolio, a mix of growth ETFs and high income ETFs, reinvesting the distributions and letting time doing the heavy lifting. When it comes to the dividend growth ETFs, the more time in the market, the more it's going to grow. As you can see, it's really not until 22, 23 years in that you start seeing serious dividend income, even though your portfolio is growing. Just the income is lagging behind. And now we're going to go to SPYI. Now, SPYI follows the S&P 500. So basically, it's the top 500 companies in the country on the stock market. We're going to do the same, start at 0. Annual contribution, $18.25. If I can type. 0. Now the dividend The dividend increase amount is only so far about 2%, so we're going to keep that there. 30 years, keep that share price appreciation about 3%. So it's going to match, be around to keep up with inflation. And that's going to calculate your ending balance, 620, 553 and 60 cents. That's your annual dividend income after 30 years. But as you can see, you're getting your dividend income a lot faster. Yes, you're sacrificing some growth, but you're getting the dividend income and it's coming monthly. So that way, depending on where you are on your investing journey, you would be getting income monthly from this and from QQQI. And this is where investing starts becoming less about chasing hype and more about building systems, because small daily investments can eventually snowball into serious portfolio income and long-term wealth, especially when those dividends keep buying more shares, which produce more dividends, which buy even more shares. The compounding effect is the part most people underestimate. And we're going to do one more. We're going to go to QQQI. Same there. Start at 0. 1825 is the annual contribution. 0 dividend tax. And the same 2% dividend growth. And we're going to project that over 30 years. And that would be your ending balance, $792, $581 and 10 cents. Your annual dividend income of $83,186.66. And then that's going to be your total return, your total dividend payments. And this is just projected out over 30 years, where year 16 is when you really start putting together all your dividend income, even though it's coming monthly. Both SPYI and QQQI being monthly, it means they're going to compound faster. So for me, this really isn't about growth versus income. And this here just made it a little easier there. That's going to be the 1 year, 5 year, 10 year, 20 year, and 30 year income for each of the 4 positions. Now the 1 year, not a lot, not much to work with. 5 year, you're starting to put together some money. 10 year, if you're considering getting close to retirement, you're getting $10,000 a year and you're starting to get money monthly. So that way, even if you're working with Social Security and possibly a pension, it worked well towards retirement. 20 years, you have a pretty nice retirement yearly income of $51,348. And if you do 30 years, if you started when you were 18 and now you're approaching 50, now you're looking at $260,000 from 4 ETFs you've been investing in for 30 years. So it's about building a portfolio that gives me motivation today while still setting up future wealth tomorrow. And honestly, I think combining these styles keeps investing psychologically easier too. You get to see income now while still owning assets designed to grow over time. That combination might end up being far more powerful than choosing sides. So if you made it this far, comment below. Would you rather focus on growth ETFs, income ETFs, or both together? And if you want to see why I think the Roth IRA completely changes the compounding equation, watch this video right here. That video connects perfectly with what we talked about today because it shows how these investments could potentially grow tax-free over the long run. I'll see you in that video.